Global markets ended the week under pressure. Crypto was no exception. After several sessions of calm trading, Bitcoin declined more than 8%, briefly touching $104,000. Ethereum followed, falling almost 6%, and most major altcoins registered similar losses. The move came after new US trade measures targeting Chinese exports added stress to global risk sentiment. The announcement, made late last week, included 100% tariffs and proposals for additional export controls on advanced technology. Markets across equities, commodities, and crypto reacted together, marking the sharpest synchronized sell-off in weeks. In total, about $19 billion of crypto market capitalization evaporated within hours. Leverage unwinds, liquidations, and option hedges amplified the decline. Bitcoin's open interest dropped sharply as traders reduced exposure ahead of the weekend. Although the headlines sounded severe, analysts classify the reaction as macro-driven, not a breakdown of crypto fundamentals. On-chain data continues to show stability among long-term holders. Exchange reserves remain low, and large wallet activity has not indicated panic distribution. The selling pressure is concentrated in short-term speculative positions, not in structural capital flight. Technically, the market has entered a testing phase. Bitcoin's key support now lies between $95,000 and $105,000, the same zone that acted as an accumulation base earlier this quarter. Ethereum's range extends from $4,000 to just under $5,000. As long as these levels hold, the larger trend remains constructive. The macro backdrop still dominates near-term sentiment. The dollar strengthened as investors shifted towards safer assets, while equity markets showed similar caution. If global risk appetite stabilizes, crypto could rebound quickly. If the dollar continues to rise, consolidation may persist into next week. Adding to the complexity, roughly $5 billion in Bitcoin and Ethereum options are set to expire in the coming days. Such expirations often heighten volatility as positions are closed or rolled forward. Traders are watching whether volatility contracts afterward, a typical sign that forced selling has run its course. Institutional participation remains steady. ETF inflows continued through the week, suggesting long-term investors view the pullback as temporary rather than structural. This quiet confidence has become a recurring theme of the current market phase, strong underlying demand coexisting with periodic macro shocks. Market sentiment indicators show caution but not fear. The shift from optimism to observation is normal in an environment shaped by external policy moves. Veteran participants describe this moment as a recalibration, a reset of leverage and expectations after months of uninterrupted gains. From a structural perspective, nothing essential has changed. The underlying technology continues to evolve, adoption trends remain intact, and the financial plumbing connecting digital assets to traditional markets grows deeper each quarter. Short-term volatility reflects adjustment, not abandonment. What matters most now is how liquidity behaves once traditional markets reopen. If inflows return and volatility subsides, the week ahead could mark the foundation for renewed strength. If uncertainty lingers, sideways trading may dominate while the market digests new information. The key takeaway: this correction is not about belief, it is about balance. Markets breathe: expansion, contraction, recovery. Each phase clears excess and restores proportion. Understanding that rhythm allows investors to respond with patience instead of emotion. For more insights on Bitcoin, Ethereum, and the forces moving the crypto markets, remember to like, subscribe, and keep learning here at Crypto in Black and White.